Welcome. Today, we're witnessing a major shift in the global economy, one that could impact everything from your car to your groceries. 7 major countries have recently slashed exports to the US, each for their own reasons. Meanwhile, Canada is stepping up, striking a billion-dollar deal that repositions it as a key US partner. This isn't just about trade numbers, it's about jobs, prices, and the future of American industry. We'll break down which countries are making these moves, why, and what it means for the US economy. Let's explore the ripple effects and the bigger picture. Grab your coffee. Let's dive in. China, the world's manufacturing giant, is shifting strategy. US-China trade once fueled the global economy, but now China is reducing exports and focusing on self-reliance. China's dual circulation plan boosts its domestic market and forges new trade ties across Asia, Africa, and South America. Mexico and Canada have overtaken the US as China's top trading partners. The world's 2 largest economies are entering a new phase, one defined by competition, not just commerce. The future of global trade hangs in the balance. Now, let's look south to Mexico. Mexico recently became America's top trading partner, but even here, exports to the US are leveling off. The USMCA trade deal brought stricter rules, especially for autos, complicating supply chains and slowing some exports. Mexico's government is also focusing more on domestic priorities, making foreign investment trickier and slowing production for export. Infrastructure bottlenecks and inflation add to the strain, making it hard for Mexico to keep up with surging demand. Industries like electronics and medical devices face hurdles, and the promise of nearshoring is running into real-world challenges. The reduction isn't hostility, it's growing pains as Mexico adapts to its new role. For the US, this means that simply shifting production from China to Mexico isn't a quick fix. Stronger partnership and investment are needed to overcome these hurdles. The US-Mexico relationship is evolving, and both sides must adapt. Let's cross the Atlantic for our next story. Germany, Europe's economic engine, is also exporting less to the US. The energy crisis, sparked by the Ukraine conflict, has sent German manufacturing costs soaring, making exports less competitive. High inflation and rising interest rates are pushing Germany toward recession, further weakening its export power. German automakers face fierce competition from US and Chinese electric vehicle brands, struggling to keep their edge. There's a shift toward strengthening the European market and building resilient supply chains at home. The export slowdown isn't political. It's a response to internal economic storms and global competition. For Americans, this could mean fewer German cars and pricier machinery. Europe's troubles are hitting home in the US in real, tangible ways. The global trade landscape is shifting, and Germany is rethinking its priorities. Let's head to Asia for another perspective. Next up, Japan. Japan, a longtime US ally, is also exporting less to America. A weak yen should help exports, but soaring import costs for raw materials and energy are squeezing Japanese manufacturers. Add in a shrinking, aging workforce, and factories can't keep up with demand. Instead of exporting, Japanese companies are building factories in the US, especially in autos and high-tech. Japanese firms are partnering with American companies, moving production stateside to dodge currency risks and shipping costs. This shows up as fewer exports, but it's really deeper integration. Japanese goods are still coming, just made in America. The US gains jobs and supply chain resilience, but the trade dynamic is changing. The traditional export model is giving way to local production. Japan's adaptation is a blueprint for other countries facing similar pressures. The US-Japan relationship is evolving, not weakening. Let's see how South Korea is handling these shifts. The story continues with another Asian powerhouse. Here's what's happening in Korea. South Korea's exports to the US are down, driven by 2 big factors: a tech market slump and new US industrial policies. The global chip market is in a downturn, so US companies are ordering fewer Korean semiconductors. In autos, new U.S. laws favor vehicles assembled in North America, putting Korean-made EVs at a disadvantage. Korean firms are responding by investing billions in U.S. factories for chips and batteries. So, while exports drop, Korean capital and technology are flowing into America. Korea is also diversifying, forging new trade deals beyond the U.S. and China to reduce risk. The export reduction isn't a retreat, it's a shift in strategy. Korean companies are embedding themselves in the U.S. economy, just like Japan. The partnership is changing, not ending. The U.S. is seeing more Korean investment, not less engagement. The global tech cycle and policy shifts are reshaping this relationship. Let's turn to India for another angle on global trade. Here's how India is navigating the new landscape. India's exports to the U.S. are down, but the reasons are unique. The Make in India initiative is redirecting resources to boost domestic manufacturing, sometimes at the expense of exports. Non-tariff barriers, like complex regulations and sudden policy changes, make trade with India unpredictable. India has restricted some exports, like food and pharmaceuticals, to protect its own market and meet stricter U.S. standards. India is cautious about big trade deals, preferring bilateral agreements, but negotiations with the U.S. are slow. The focus is inward, not anti-U.S., but it complicates trade. For the U.S., unlocking India's potential means navigating these regulatory hurdles. The partnership is full of promise, but also complexity. India's evolving stance is reshaping its role in global trade. Now, let's head to South America. Brazil, a global agricultural powerhouse, is sending fewer exports to the U.S. The main reason? China's demand for Brazilian commodities is outpacing America's, so more goods are heading to Asia. Political instability and economic volatility at home disrupt production and investment. Environmental concerns, especially deforestation, mean stricter U.S. and European regulations, making exports to the West more complicated. Infrastructure bottlenecks force exporters to prioritize their biggest customers, usually China. Brazil's shift is about following the money and adapting to new pressures. For the U.S., this means less reliable access to key commodities. China's influence in the Americas is growing, reshaping trade flows. Brazil's crossroads highlight the intersection of economics, politics, and the environment. Let's bring it back to North America for the final act. With major economies cutting exports, the U.S. faces new challenges and new opportunities. Canada is stepping up, striking a billion-dollar deal focused on critical minerals and clean energy. This isn't just trade, it's a strategic partnership for a secure, resilient North American supply chain. The global trade map is being redrawn, and the U.S. must adapt. The challenge: navigate disruption. The opportunity: build prosperity closer to home. We'll keep watching as this story unfolds. Thanks for joining us.